methods of providing credit. Now, we all discussed that if there is any tax which is paid in the source state, right, the state of residence should give a credit for those taxes. But how would the procedure actually work? So there are two methods which are applicable, which is the exemption method, and then there is a credit method, right? So let's first discuss about the exemption method. In this case, let's take an example. Suppose there's a US tax resident, okay? He has an income of $100 in India, okay? And he has an income of $500 in US, right? Under the exemption method, what is going to happen is, suppose he has paid taxes in India amounting to $30 on such income, right? So how would the exemption method work? The exemption method has two things. One, a full exemption, or second, an exemption with progression. What happens is, in case of full exemption, taxable income of source state is not considered at all in the state of residence. What this means is, when calculating the US taxable income, they are going to say from India, we have zero income and therefore the total income is $500, right? The second method is, so this is known as full exemption. You do not include the income at all. The second one is exemption with progression. Income is only considered for determining the applicable tax rate. So suppose the taxable income again is 500. What they are going to do is, they are going to consider this $100, but only in order to ascertain if there is an incremental tax which might be applied, right? Now, for this you might have studied about the taxation of agricultural income in India, which is exempt from tax, but it is considered to see whether your slab or the tax bracket in which you fall may actually increase, right? This is also something similar. You do not tax this income, but you will just add it on to the total income to see what is the total tax which is payable on such income, right? Once you get the total tax on 600, right? Let's say it is 200. Just a thing that I'm saying here, right? Then you calculate what would be the tax on this 100 and reduce the tax on this income from the total tax which is due. So let's say if this tax were 30, right? 170 is what you pay. Now, what I mean by that is, let's say for example, if on 600 you were paying a tax of 200, the rate was 33%. Average rate was 33%. But if the tax on this income of 100 was 30, here the tax rate is 30%. When you give exemption with progression, what is done is, effectively there are chances that this tax rate which US may recover may stand to increase only in cases where the taxpayer has different brackets of taxation. In case of credit method, the state of residence provides credit for taxes paid in source state, right? So continuing with this very example, in this case the taxes which were paid in India were $30, right? Now let's say for example on this $500, tax rate in the US were 40%, right? Out of this 500, there is no credit which is available, but if you include the $100 which you have earned from India, the tax on that will be $40, right? Against this $40 of taxes which are to be paid, a credit will be given for $30 for the taxes paid in India, and therefore the cash taxes to be paid in the US is going to be only $10, right? This credit is generally restricted to the amount of tax which is payable in the state of residence. What this means is, if on this $100, the tax rate which was to be applied was 20% and therefore the tax liability was only $20, even though tax has been paid in India to the extent of 30, the credit will be available only for $20 and the tax on this income will be 0. You cannot use this 10, the tax paid in India 30 minus the credit which is available $10 to offset the tax liability against other income, right? Of course, there could be domestic rules under which this could be carried forward, but you are not entitled to set it off against other income unless the domestic laws specifically provide for such a treatment.